Here's something that should stop every precious metals trader in their tracks. Traders are easing back their bets on further Federal Reserve interest rate hikes, which is normally the exact recipe for a silver rally. Less chance of higher rates usually means a softer US dollar and lower opportunity cost for holding a non-yielding metal like silver. Instead, XAG/USD has done the opposite. As of today, Tuesday the 28th of July, 2026, silver has slipped to near $57.50, pulling back from stronger levels just days earlier. If you've been watching silver's remarkable run higher through 2026, this reversal matters, because it's happening against a backdrop that should theoretically be supportive. So what's actually driving the move, and does it change the bigger picture for silver? That's exactly what we're unpacking in this video. Let's break down the disconnect. Over the past week, incoming data and Federal Reserve commentary have led markets to trim the odds of additional rate hikes, a shift that usually weakens the dollar and lifts dollar-denominated commodities like silver and gold. But silver's recent surge had already pushed it to levels that left the market stretched. When an asset climbs as fast as silver has this year, even genuinely supportive news can trigger profit-taking rather than fresh buying, because traders who bought in earlier are locking in gains at the first sign of hesitation. Add to that a US dollar that hasn't actually weakened as much as the rate expectations alone would suggest, and you get a silver market pulling back even while its main long-term driver, softer Fed policy, edges the right way. This is a classic case of near-term positioning overriding the underlying fundamental story. This pullback isn't just a line on a chart, it has real consequences today. Retail investors holding silver ETFs or physical silver are seeing paper gains shrink in the short term, prompting some to reassess whether the rally has further to run. Meanwhile, industrial buyers, particularly in solar panel manufacturing and electronics, where silver is a critical input thanks to its unmatched electrical conductivity, may see this dip as a buying opportunity to lock in lower input costs before any renewed rally. Options traders are also active right now, since a fast pullback after a strong uptrend typically increases implied volatility, making silver options more expensive to trade. For mining companies, a dip to $57.50 still represents a historically elevated price, so producers are unlikely to be alarmed, but it does affect how they hedge upcoming production in the derivatives market. Silver isn't moving in isolation, and looking at related markets helps explain the mood. WTI crude oil has also cooled, slipping back toward the $90 mark even though its broader bullish structure remains intact, suggesting energy markets are seeing similar profit-taking after a strong run rather than a genuine change in trend. At the same time, the US dollar is behaving unevenly against different currencies. US dollar to Canadian dollar has fallen to nearly monthly lows below 1.4050, and the Swiss franc has firmed slightly as oil prices ease, both signs of broad dollar softness. Yet silver still isn't benefiting the way you'd expect from that same dollar weakness. That inconsistency across markets tells us this is more about metal-specific positioning and profit-taking than a fresh macro shift against precious metals. From a technical standpoint, $57.50 is acting as a near-term pivot for XAG/USD. A clean break and daily close below this level would open the door to a deeper corrective move, with traders likely eyeing the next psychological round number as the following support zone. On the upside, silver needs to reclaim its recent highs with conviction to convince the market that the pullback was simply noise within an ongoing uptrend rather than the start of something bigger. Momentum indicators are cooling off from overbought territory reached during the recent rally, which is typical after such a sharp advance and doesn't necessarily signal a trend reversal on its own. Traders should watch trading volume closely, since a low volume dip is far less significant than a high volume breakdown through key support. The next few days are unusually loaded for precious metals traders. This week features policy decisions from the Federal Reserve, the Bank of England and the Bank of Japan, all landing in close succession. That's a rare alignment, and it means silver's direction could hinge heavily on the tone each central bank strikes, not just the actual rate decisions themselves. A more dovish than expected Fed statement could quickly reignite silver buying, while a Bank of Japan move toward tighter policy could strengthen the yen and add further cross-currents into dollar pairs, indirectly affecting silver pricing. Given how sensitive markets are right now, expect sharp, fast moves around each announcement rather than the type of gradual drift we've seen the past few days. Putting it all together, the near-term outlook for silver looks like consolidation rather than collapse. The underlying case for silver, easing rate hike expectations, robust industrial demand from the solar and electronics sectors, and ongoing safe haven appeal amid global uncertainty, remains largely intact. What we're seeing at $57.50 looks more like a healthy pause after an aggressive rally than the start of a structural downturn. That said, traders should stay alert heading into the central bank decisions this week, since any hawkish surprise from the Fed could extend the current pullback further before buyers step back in. Watching how silver behaves around the $57.50 level over the next 48 hours will offer an early signal of which scenario is playing out. Here's the key thing to remember. Silver falling despite easing Fed hike bets isn't a contradiction. It's a reminder that markets that have rallied hard often need to breathe before moving higher again. The fundamentals supporting silver in 2026, industrial demand, safe haven flows, and a Federal Reserve leaning toward a less aggressive stance, haven't disappeared, they've just taken a back seat to short-term profit-taking. Keep your eyes on this week's central bank decisions, because they're likely to decide whether $57.50 becomes a springboard for silver's next leg higher or a stepping stone to a deeper correction. If you found this breakdown useful, subscribe for daily updates on silver, gold, and the wider Forex market, so you're never caught off guard by moves like this one.